Okay, let's dive right into this explainer, and honestly, let's shift your mindset. If you've been avoiding your financials until tax season rolls around and you're sitting there wondering why you're always feeling broke despite working nonstop, well, you are definitely not alone. Today, we're moving from financial avoidance to complete empowerment. We're going to build a practical visual dashboard so you can finally stop working those grueling 60-hour weeks while essentially flying blind. Our goal here is actually really simple. We are going to peel the tape off your dashboard. We're building your financial literacy right from the ground up, and we're going to master the specific metrics of profitability and growth. Our objective? It's powerful. We want to ensure you never, ever have to face another dreaded April tax disaster just because you didn't know what was actually happening under the hood of your own business. So here's our roadmap for today. We're installing 5 essential dials: reading the profit and loss, 7 KPIs that run businesses, paying yourself the right way, surviving the April tax disaster, and finally, the ultimate year-end review. All right, let's get started. Section 1, reading the profit and loss, your business report card. It all starts right here. Revenue is your top line. Basically, it's simply the total amount your business invoiced and collected. Sure, it shows activity, but remember this absolutely vital warning. A healthy bank balance and high revenue can easily hide a losing business for months. Revenue just means you're busy. It does not mean you're actually making money. Now, just below that, you'll find cost of goods sold, or COGS. These are the direct costs of actually performing your work. We're talking your materials, your labor, your subcontractors. What you really need to remember here is that these costs move exactly with the work you perform. They drop when revenue drops, and they rise when it rises, purely because the job exists. And that brings us to gross margin, which is your revenue minus your COGS. Think of this as your engine's efficiency. How much of every single dollar actually survives after the direct cost of doing the work? For trades like roofing or exteriors, you should be targeting a 40 to 55% gross margin. If it dips below that, you immediately know you've got a pricing, material, or labor issue to fix. Next down the list is operating expenses. These are your fixed overhead costs. Things like insurance, vehicle payments, software, marketing, and while a $49 subscription here or a $100 fee there might seem totally insignificant on its own, these expenses can silently bleed a service business completely dry if they aren't strictly monitored. They basically attack your profit from below. Finally, we reach net profit. This is the ultimate bottom line. It's what's left over after subtracting both your COGS and your operating expenses from your revenue. This answers literally the only question that truly matters. Did the business actually make real money this month? A strong net margin is generally above 15 to 20%. If you're sitting below 10%, it's time to check your pricing or overhead immediately. Section 2, 7 KPIs that run businesses. Fewer, better numbers. You really don't need 50 metrics to run a successful crew. You literally just need these 7 gauges. For example, look at average job size. Knowing your revenue per job is absolutely critical. I mean, jumping from a $4,500 average job to a $14,000 average job, that completely redefines your market position and your profitability without you having to run any extra estimates. Or take AR days, which shows how fast you collect. If that creeps past 30 days, you are effectively financing your customers' projects interest-free, and we definitely don't want that. Perhaps your most critical safety gauge of all is maintaining 2 to 3 months of overhead in cash on hand. Now, this isn't money just waiting to be spent. This is your liquidity buffer. Keeping this strictly monitored prevents a total, full-blown crisis when an inevitable slow season hits or when a big client suddenly delays payment. Moving on to Section 3, paying yourself the right way, owner draw versus salary. When it comes to paying yourself, we see 2 destructive extremes all the time. On one side, you've got the random cash puller. This person treats the business checking account like a personal ATM, essentially looting the company's working capital. On the flip side, you have the starving martyr, who lives on pennies, hoarding cash unproductively out of sheer fear. Listen, you simply cannot grow a business if you're starving it, and you certainly can't grow it if you're constantly looting it either. So instead of living in those extremes, let's use this clean 4-step framework for an LLC owner draw. First, calculate your actual average monthly net profit. Second, immediately reserve 25 to 30% of that for taxes. Third, reserve another 10% to build that cash buffer we were just talking about. Whatever is left over in step 4, that is your sustainable draw range. Pick a number in that range, set a specific day to take it, and stick to it with absolute discipline. Section 4, Surviving the April Tax Disaster, Tax Basics for Owners. Okay, unlike a W-2 employee who has everything handled automatically in the background, you are firmly in the driver's seat now. You have to actively manage both your standard income tax and the surprising 15.3% self-employment tax. That combined rate is exactly what catches so many business owners entirely off guard come April, leaving them scrambling in a panic to pay a massive unexpected bill.
So your best defense is what we call the reserve rule. You need to get into the rock-solid habit of immediately transferring about 30% of your net profit from every single job into a dedicated separate tax account. And the golden rule here is you never, ever touch it. It's not your money anymore. It belongs to the IRS. If you pay them first in your mind, you'll never be broke when the real bill comes due. But hey, it's not just about paying taxes. It's about paying the right amount. Actively tracking legitimate business deductions, things like your vehicle mileage, tools, equipment, software, and insurance, can legally reduce your taxable income by thousands of dollars. Keep those receipts organized by these categories throughout the year. And no, a shoebox full of crumpled receipts on the floorboard of your truck absolutely doesn't count. Organize them so your CPA can actually defend your hard-earned money.
Finally, Section 5, the ultimate year-end review, closing with confidence. I absolutely love this quote because it perfectly captures the shift we're making today. Reviewing your numbers regularly and then doing a deep dive at year-end prevents you from blindly repeating a stagnant year. It transitions you from merely reacting to fires to deliberately designing your company's future. So here's how you actually execute that review. Close the books completely, run the full year P&L, and compare your actuals right up against your goals. See exactly where you won and where you bled cash. Review your categories. By doing this systematically, you can confidently use your off-season data to do things like justify a crucial 2 to 3% price increase for the upcoming year, which, by the way, drops directly to your bottom line. So I want to leave you with this provocative thought to really challenge your current operating mode. Are you building a truly profitable business, or are you just running exhausted on a treadmill? It's time to check your dashboard, look at the honest truth of your numbers, and finally take control of your financial future. Thanks so much for joining me on this explainer, and I seriously challenge you to put these dials in place today.